From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, March 26th, and you're listening to the HPS Macrocast. I'm Bryan DeAngelis, in for Tony Fratto this week, and I'm here with John Fagan and Brendan Walsh from Market Policy Partners. Guys, good morning. A lot to cover this week. One of the topics I want to get into that I don't think we've discussed in a little bit is it seems that inflation and the risk of the economy overheating is the hot topic this week. A lot of coverage in the media, a lot of discussion in this week's Senate Banking and House Financial Services hearings with Yellen and the Fed chair. So let's start there. I thought the hearings themselves were, I dare say, largely uneventful, but a lot of talk around inflation. What are your guys' takes on this?
So actually this morning, we just got the core PCE price index, which is the Fed's preferred inflation measurement. And they targeted at 2%. And the popular media is worried that we're going to go to, seems like 10%. But it actually was, it disappointed the market today. So on a month over month basis, it rose 0.1%. The market was expecting 0.2%. And that actually brought the year over year number down from 1.5% to 1.4%. And a lot of that was services, especially the housing component of the measurement, which is, it's a little quirky the way that we do our housing measurement. We measure it at how much you can rent your house for rather than how much your house price has gone up or down.
Worth, yeah.
So because of the pandemic, rental prices are down a bunch because everyone's moving out of cities into the suburbs, and we heavily weight our measurements to larger cities. You know, places like San Francisco and New York City, it's down as much as 30-40%. So, but also that's a very sticky measurement. It's really an 8-month rolling average. So this is going to be a reality for this measurement, and the CPI uses actually the same component. The PCE actually steals it from the CPI, but it's the exact same methodology. So, you know, when you have Powell and Clarida this week, you know, talking about we're not that worried about inflation. If it goes up, we're going to look through it because we really think the growth is going to be so strong, and that's our priority. They actually do, from just a simple methodological standpoint, have a lot of cover, but that's kind of getting wonky. The bigger thing I think is interesting to talk about is people are comparing this to the 1970s, where we actually did have 10% inflation, and the world's a very,
which I think is apples and oranges, right?
Yeah, I agree.
Yeah,
and we were talking about, you know, if this boat got stuck in the Suez Canal in 1970, we'd all just be dead, you know, like the whole world would end.
You'd be sitting in your Dodge Dart in a 3-mile line to fill up.
Yeah, and you could get 1 gallon.
But yeah, inflation has been something that maybe filtering into the inflation risks, maybe filtering into the popular consciousness around now. This has been something that market participants have been grappling with for a pretty long time, actually. And this is a long time building up. And actually, we saw this is reflected typically, as we've said in previous shows. If you're looking at market-based gauges of inflation expectations, you're looking at the TIPS, the inflation protected securities, what they call break evens, which is the rate of inflation that is being implied by where TIPS are trading. And the 5-year and 10-year break evens are kind of the key ones that you're focusing on. Those have been in a, you know, almost inexorable rise for the last, like, you know, since the depths of the pandemic, really, from a very low base. And now they're trading at somewhat elevated levels. You know, when you look at the 5-year break even, it's at 2.63 right now. The 10-year is at 2.35. Those are obviously above the 2% target. But, you know, as Brendan said, this is a Fed that has recalibrated their target. This is now an average 2% over a period of time, an undefined period of time, which implies that the longer we stay below 2%, the longer they'll be comfortable with it running moderately above 2%. Now, where is the level? A lot of the questions that have been leveled at Chair Powell and some of the other Fed speakers, what's your level? Where's your red line? When do you start freaking out about inflation? Obviously, they're not going to give you some sort of like red line number, but the finger in the wind and the kind of discussion points been around, like, 2.5 would be fine. And as long as we know that it's not on a straight up trajectory and we don't think it's going next stop 3%, we can work with that. So the break evens right now are at levels, and importantly, the 5-year is above the 10-year, which means that the market is at least in kind of concept thinking that there's going to be a bump before it eases off a little bit. And these levels, while they may be, near decade highs or even longer in the post-financial disinflationary post-financial crisis era, these are not particularly challenging levels on their own. And neither of these levels is an outright defiance of the Fed. Go up, 20 basis points, 30 basis points from here, it's a different story.
So
I've been struggling this week, like trying to wrap my head around how much of this is public perception and even, dare I say, talking points versus reality. It seems like that the threat of inflation has replaced talk about deficit spending and other issues. And a lot of them are assuming we get inflation if Biden passes his $3 trillion infrastructure bill, which is still a big if.
Yeah, because if you pull up a chart of core PCE for the last 30 years, we never get above 2%. It's always 1.5 to 2%. It pops above, and same with headline. If you look at the University of Michigan does a survey, and they always ask the 5 and 10 year. The 5's always about 2.5, and the 10's always about 3. So, and that hasn't really gone up a bunch in this current thing. So I think we're basically using inflation as a way to talk about this spending. It's a proxy essentially for I don't know if we should spend $3 trillion because we're going to get inflation.
Well, I think that there's part of it is that the Tea Party, they sort of rummaged around in their closets for the Tea Party uniforms, but after 4 years of letting the deficit flow out, it was a little bit harder to make the case that they were like dyed-in-the-wool deficit hawks. So that has really kind of been, even if you want to, as cynical as you want to be on Capitol Hill, it's a little hard to make the case. And the Democrats would obviously come at them with that sort of set of charges. So perhaps inflation is the better pushback. At least for now. Certainly the public consciousness about inflation, we've seen survey metrics that are showing an increased awareness. And that has been something that Fed Chair Powell has said, as we talked about before. He said that this is going to be a transitory bump. We'll talk more about, supply chain, the reason. And it's not just statistical, it is relinking the global supply chains that have been dislocated or broken or disrupted.
And on that front, we are seeing, inflation. So the global PMI surveys, so you survey a purchasing manager who is the one that sees, he buys and sells things.
Right.
And on that front, you are seeing inflation. So we're seeing a huge amount of demand coming back, and we're also seeing supply chain constraints. And also the PPI. So that's the producer. So, but what we're not seeing yet is the producers passing it on to consumers. And that's the one that matters for the Fed. The supply chain has nothing to do with monetary policy. It has to do with a global pandemic. And you just need time to work that through. The level of rates don't really, I suppose if you hiked rates a lot, it would hurt, but you're not going to solve that problem at the monetary level. That has to be at the federal level, essentially, or just let the market, heal.
And there's certain, when you think about what are the cost ramifications of this, we've seen this chronic chip shortage now, and lack of semiconductor availability has put the F-150, the production line of Ford, on mothballs over the weekend.
You know how many semiconductors are in a car now?
Yeah, it's just it's a rolling computer.
They're basically computers.
There's 180 semiconductors in just a normal, Ford Taurus or whatever.
Yeah, and if it were a question of price, Ford would just pay up. But it's
not
straight up availability. and for love or money, you can't get enough chips. So the production lines, particularly in automobiles, NIO, an electric vehicle maker out of China, has announced a similar production stop.
And they make them all in Taiwan, and we're about to go to war with China, so we're going to lose all our semiconductors.
Let's hope not.
We'll save that for another episode.
Yeah, the jury is really out as to how this ultimately settles out in prices. I think that it's easy to make the case that we'll get back to the status quo ante, and supply chains are so efficient, and the logistics geniuses that are out there will solve these problems, and we'll get back. But underlying this, there is some there are these underlying aspects, such as the reshoring, the dislocation between US and China. These are longer run, and so that raises questions about whether we really can get back to the status quo ante. The reshaping of our understanding about supply chains as a national security issue. So even once we work through these near-term dislocations, there are probably some structural changes in the way that supply chains are going to be managed, and the way that the federal government is going to be orienting themselves toward this issue. But that's really kind of
and there is a bit
great
of a
point, and we'll find out next week with the when Biden releases the bill. But it's a misnomer. We keep calling this thing an infrastructure bill. That's part of it. But I do think a lot of it will also be the national security, supply chain. And this isn't something you write a check and do it one day. This is a 10, 20-year issue that we're going to be dealing with.
Right. No, this is a Santa Claus Christmas wish list bill. This is much more than infrastructure. And I do think part of this is a little bit of a reverse sugar high, right? We had an unprecedented shutdown. We are going to have a pretty unprecedented reopening. I mean, I think demand is going to be.
You're already seeing it,
And I'm excited to get out there. I'll be eating at restaurants like every chance I can get. But
no, I know my parents.
That's not going to last forever. I'm not going to do that for the next 10 years.
Fifth Ave in Naples, Florida is like Mardi Gras for 70-year-olds. It's pandemonium down there right now.
Well, this is the one of the dynamics playing out in financial markets right now is the diverging expectations for the US recovery and Europe's recovery to a great extent. German Chancellor Merkel announced a 5-day hard lockdown over the Easter holiday earlier this week. She backpedaled a little bit on that, but that is emblematic of how things are going in the EU right now. We've got,
but it's a really important point.
Distribution has been lagging dramatically, and it's just going to be, the U.S. sort of consumer and risk tolerance and ability, willingness, and wherewithal to get out there and recover from this may not be, nearly the same intensity in Europe. And we've seen this play out in dollar strength. The dollar.
That's what I was going to say. It's really hard to have a huge inflationary environment when you have a strong dollar.
Yes. And so there's a self-correcting element of markets. Markets are expecting a big burst of US growth and maybe some inflation. So they're doing some of the tightening that the Fed is saying that they won't do. Real interest rates are up pretty substantially, not tight, but up off the most, lowest levels.
And that's what Florida was saying. He's like, we're not going to raise rates, but I think the market will.
Yeah. And so when that is actually a pretty helpful dynamic for policymakers. They can hold the line on their ultra accommodative policies and let the market do some of the tightening for them. And we've seen this playing out in some of in financial markets. The inflation is expressed in the momentum driven stocks.
Yes.
Bitcoin, Tesla, ARK Innovation ETF, these really fizzy and momentum driven parts of the asset world have taken on a lot of water over the past few weeks, some of them for even longer. We've seen, Bitcoin was maybe the last domino to fall into this corrective camp, and it trades on a little bit of a different logic, but it's down pretty substantially, it's almost down 10% over the past week. And when you look at things like ARK Innovation, those are down like 25-30% from their peaks. Now they're still like some of them, their peaks have been so outrageously high that some of them are still up on the year. But in terms of like the animal spirits that like, that have been coursing through the market, the higher real treasury yields and the stronger dollar have blown some of the froth out of there. And so that inflationary impulse is deadened.
This is a perfect example of the difference between, if you're a market participant trading this market on a day-to-day basis, this market's been really hard because you have incredible churn in stocks. One day the tech is down, and then the next day, banks are up, and it's just very difficult. And because of that, the market expected Powell a few weeks ago to announce an Operation Twist to get this market under control. From a policy maker standpoint, you're ecstatic exactly what's happening. The overall market's steady, the treasury market has settled down, rates are not going crazy, and you've taken the froth out of some of the frothy stuff.
Right. Well, let's take a break there. I want to come back, and I do want to talk about the boat. I want to talk about some other global issues that are impacting all of this. So we'll take a quick break and be right back on the Macrocast.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
And we're back on the HPS Macrocast. Bryan DeAngelis here from Hamilton Place Strategies and for Tony Fratto today. And as always, I'm with John and Brendan from Market Policy Partners. All right, guys, I thought GameStop would be the craziest market story of 2021, but we got to talk about the boat. Started as a hilarious story on Twitter, but the deeper I dive into it, this is a pretty serious global ramifications on supply chains and some other issues. Tell us what's going on here.
Well, do you know what the captain did while he was waiting to enter the Suez Canal?
I don't.
He drew male genitalia and buttocks on the map. I
did see this on Twitter. I wasn't sure if I should believe that.
So it's fitting that he clogged himself in the Suez Canal.
We might have to put an explicit rating on this episode.
That's basically as much as I know about this whole thing. So I'll put myself on mute from now on.
Well, John, maybe you could give us a little more detail of that.
Yeah, so the timeline for refloating the Ever Given here is stretching out couple of weeks until the next moon tide. Everybody's seen pictures of everybody's seen pictures of that little insignificant digger like scooping out the sand. It looks
the
like
little excavator that could.
Yeah. Well, the one interesting fact I did hear. So the amount of weight that is in the front of that boat is equal to the Sears Tower in Chicago. Like that's how heavy this thing is. We're not talking about a boat. We're talking about a city.
Yeah.
Did I read right? 20,000 shipping containers. I mean, this is a massive boat. And it is having an impact, right? Shutting down or delaying supply chains where, not only is it what's on that boat, but certainly I think there's now, right, a big waiting line to get in the canal.
Yeah. Hundreds of boats, hundreds of shippers piled up on each side. You can see the satellite imagery. It's obviously a real log jam on both sides of the canal. The boats going around the Cape of Good Hope. When's the last time? I think the last time the Cape of Good Hope that got that kind of traffic was probably in the 1850s.
Spanish.
Right. The peak.
It's really expensive to do that too. That's a tough decision to make.
Yeah. And again,
the costs here are huge.
The question is really, is this, this is obviously we assume that it's temporary, whether it's a week, whether it's 2 weeks, they're going to get that boat out of there one way or the other. And this thing is going to loosen up, but it's another factor that shines a spotlight on the vulnerabilities of this vital global network, which has clearly come under enormous pressure and in some cases performed admirably, but in a lot of cases fallen short. And it, as we said in the previous segment, it gives policymakers a lot to think about in terms of risk management and how they're engaging with the private sector on this kind of issue. We've seen it, obviously some companies are more impacted than others. Caterpillar is one company that's come out and said that deliveries are going to be delayed because of this. The energy markets have been not knowing which way to break. We've had wild volatility in oil markets over the past week. We've had movements of between $2.50 and $4 a barrel of Brent crude oil over the past 3 sessions, as the markets can't figure out whether this is whether this is good or bad or indifferent for global oil markets.
I know. And we get the Baker Hughes rig count later today. The OPEC has no idea how to handle the shale guys anymore.
So it's although everyone understands that it's temporary, it is, it's a symptom of a larger, of a larger set of issues, and that concept of supply security, domestic security. It's, when we've talked with policymakers in the past about, on both sides of the aisle, about U.S. shale, it's a really interesting dynamic. Obviously, you've got environmental issues, and you've got, on the left, you've got about impacted communities, disproportionately impacted communities. And on the right, you've got the drill baby, you've got on the extremes, you've got the drill baby drill crowd.
Drill baby drill, yeah.
And, whichever side of this debate you're on, you have to contend with the fact that U.S. shale oil is a swing production in a really important swing producer at that.
Yeah.
And
they made it through the pandemic. We did not see the high yield losses in that sector that you would have expected. They survived.
So OPEC's, the recent OPEC meetings, now they're having monthly meetings to try to, get maximum pressure on the cartel, the fractious cartel members, to hold the line on production cuts. Saudi has shouldered an enormous amount of the additional cuts themselves just to keep everybody else in line. This has been a very Saudi-led effort. They've done it's incredibly well in keeping this group, and it's Russia as well, which isn't even a member of the cartel, in line through some of the toughest times of the pandemic, with oil prices up, knocking on the door of targeting like $70 a barrel in Brent. That's a really enticing level for some of these countries to start cheating and pumping and grabbing some extra market share and so forth. But the Saudis have really kept people in line. Yeah. That can only last so long.
But I would love to be at one of those meetings. Before it was very geopolitical. Now it's like, freaking Joe in Pittsburgh keeps pumping.
Yeah, well, the Saudi energy minister came out after the last one, and they said, we talked about this on a previous Macrocast, where the Saudi energy minister said, I think the dynamics in the shale patch in the U.S. have changed. It's much more mature now. They're going to be focused on profitability instead of just and supply discipline rather than just drill, baby, drill. Really? And Tony was quick to question that.
Because every day they figure out how to make it cheaper, so they just keep drilling.
100 years of U.S. breakneck oil history, but it really is the domestic supply, the impetus toward bringing it home, and we saw this. When the announcement came earlier this week that Intel was ponying up for 2 big foundries in Arizona, that's a big win. And it's a really important, not just for the economy, but for this concept of a national security.
I know.
Concept of our supply chains.
The Kodak loan ended up turning into an Onion article, but it actually was a very good idea.
Yeah, it's a good point. Well, let's jump around the world a little bit. Turkey seems to be a disaster right now. Once again, the president there interfering with monetary policy. I think another central bank change. What's going on? Tell us.
We just did a call for some clients, and I think the way John described it is the central bank governor got fired for doing too good of a job.
Yeah. He the central bank governor
sounds a little familiar with what our last president tried to do. But
Yeah, the now fired central bank governor had presided over more aggressive rate hikes than anticipated, and last week put the policy rate up in the face of rising inflation, up 200 basis points, taking the 1 week policy repo rate to 19%. Imagine that. That's a different world entirely. And so, price pressures are over 15%. As a central banker, you got to do something. And he made his move, and the president decided that it wasn't to his liking. And so Erdogan sent him packing and replaced him with an academic who had been critical of rate hikes. Erdogan has constantly railed against rate hikes, blaming higher interest rates for higher inflation, which is the opposite of economic orthodoxy. And we saw a lurch higher. A lurch lower in the Turkish lira. It was down 10% on the day on Monday after the firing. The spillover into other.
Yeah, I wanted to ask
the
that.
equity market took a beating, and the local bond market did as well. But the spillover is something that is a little bit more nuanced. In the past, when emerging markets as a broad concept it's just
right.
It's too diffuse. What does it cover? I mean, is South Korea an emerging market? Is that,
right.
What is this a meaningless rubric at this point? And so emerging markets used to kind of trade very much in line with each other. They used to be linked in a more direct fashion than they are now. There's more differentiation, more divergence, and that's in line with fundamentals. We've seen the spillover be relatively modest, but it's a little hard to tease out spillover from Turkey from pressure that other emerging markets have been feeling anyway. Brazil has,
right.
Similar problems. They're having a big growth disaster, horrible struggle with COVID, high inflation. It's a bad situation. The central bank is getting aggressive there, but the currency is losing. And we've seen, the oil price coming off and impacting Russia and some of the other more energy dependent emerging markets, and just broad dollar strength with, underpinned by the coiled spring of the U.S. economic recovery here. It's a challenge for emerging markets. And so maybe there's an element of spillover, but it's hard to really pin it on Turkey, because the problems in Turkey, to the extent that there's such a greater degree of magnitude than anything else. The sell-offs that have been going on this week in other emerging market currencies have been pretty in line with just like worsening fundamentals.
And I also think in our career, we've been doing this 20 years with EM. EM is probably it's a misnomer now,
Right.
Emerging market countries can trade on their own like never I've seen before. The amount of contagion that used to happen was massive. Now it's a lot more disconnected.
Like Asian emerging market currencies have been up this week, whereas the Turkish lira is down like 12%.
Yeah.
So it's a very, it's a meaningless kind of designation, increasingly meaningless designation, even though it still gets piled into
especially because China is still in the EM, and
right.
What goes on in China, it really has nothing to do with what goes on in Turkey.
Yeah. All right, let's take our last break. We'll be right back and give a look at what to expect next week. You're listening to the Macrocast.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter @marketspolicy.
We're back on the HPS Macrocast. I'm Bryan DeAngelis, filling in for Tony Fratto this morning. Brendan, I want to just wrap up with what to expect next week. We'll have jobs, and I'm curious to hear from you guys. It'll be Secretary Yellen's first FSOC meeting. Climate change, interestingly, is number one on the agenda. What do you guys make of this?
Yeah, so I mean, climate change is a big deal, but it's also a huge can of worms. If you try to, put a carbon footprint on a bank's lending book, that would be tough. So I'm fascinated to see what comes of this hearing, but more importantly, we're not going to decide it this week, but it is an issue coming forward for banks, especially the next 4 years under the Biden administration, where green is a big deal. But it is just logistically, I don't know how you would implement it. The other thing we got this week, so last week we found out the market was very worried about the SLR. The Treasury had given banks a little exemption during the pandemic to the treasuries they held. They didn't have to hold capital.
Right.
So they rolled that off, and that it kind of became a non-event. But actually, what kind of got missed in that announcement was that going forward, if banks are able to pass their stress test, they're going to have a little more leniency in terms of their capital return, which was a little bit a surprise. I think I don't think a lot of people were expecting that.
No, not at all. Great.
I think one of the other FSOC issues, it's going to be very interesting. Obviously, like climate change, if you're going to be scoring the banks on it, there's also an interest in trying to focus the banks on making investments and loans and directing capital toward businesses that are more carbon and more environmentally sustainable. So whether it's exactly how they come at this issue, it's going to be interesting. I think one of the other sort of to-dos on FSOC, we'll see if it comes up this time, is looking at the non-bank financials. The idea that we've got all these stress tests for the banks, but we had a real life stress test for the bank. We had COVID hit us a year ago, and
that's a great point.
Yeah, and boy, if you're a policymaker, if you're at FSOC, don't you can give yourself a little pat on the back, I think, for the dog that didn't bark, which was this global pandemic didn't turn into a U.S. banking fiasco, and I think that the risk management and
$5 trillion can help avoid bank losses. The response is helpful too. But when they're looking at places like, if they're looking at their remaining sort of to-do list and danger zones, then it really has been the non-bank financial institutions. The idea that if you've managed to get a greater control of risks in the mainstream and large banking sector, perhaps those risks have migrated out to other parts of the market that are harder to see.
This was
that line of
Warren's
inquiry
push this week, right?
It's a legit line of inquiry, and it's not surprising to see it come up.
But Bryan, going forward, I think we should do a podcast on how the bank lending and green energy, because so it's one thing, okay, don't lend to a guy pumping oil, and we're going to go to all electric cars, but am I allowed to loan to the guy in Texas who's digging up the earth for rare earth to make that battery? It's a much more complicated issue than the popular media is.
It's a complicated issue, and it's clearly a top priority for Biden. I mean, you're seeing these task force step up at the SEC. You're seeing FSOC, like they are putting this number one on their agenda. And you're right. I think it's going to be complicated and challenging, and we'll see what comes out of this.
Yeah.
All right, guys, let's leave it there. Thank you for entertaining me this week in my guest host role, and thanks to all our listeners for tuning in to another episode of HPS Macrocast. I'm Bryan DeAngelis. John, Brendan, thanks again, and everyone have a great weekend.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.